All right, good morning and welcome to a new trading week, everybody. Hope everybody enjoyed their weekend. Got about 12 minutes to the bottom of the hour. Futures so far this morning, as you can see, under a little bit of pressure here with the NASDAQ futures outperforming a little bit, although we've lost about 10 points in the NASDAQ futures over the last half hour or so here. We do have the VIX up, which is typical for a Monday morning. We have the weekly hedging programs already in force, coupled with the VIX reset from lowered options bids on Friday. And that's all manifested in the VIX, usually more than 67% of the time up Monday mornings, more than about 62% of the time up Monday on the whole. And of course, that's usually unwound with the exact same statistics, but to the downside on Friday as those weekly hedges roll off. All right, so Asia overnight, not much. Bonds this morning, yields after a really robust move on Friday, up some 8 basis points at one point. The 10-year yield, you can see it's down about 1 basis point. This is off of its worst level. It had been down 0.017 at its lowest level this morning. So we'll see how this meanders throughout the day. Coming into this week, the yield curve did steepen on Friday from 102 to 110. Again, the 8 basis point move there in the 10-year yield. So spreads between the 10-year and the 2-year. Now at 110. It did briefly break below 100 basis points for a couple of days there, a couple of weeks ago. Maybe the banks, maybe the small caps, maybe that reflation trade is going to come back to some degree. Maybe some of that reflation trade and financials and banks, starting to perform again will come with the Jackson Hole, announcement of some sorts regarding the Fed's asset purchase program. I'm still skeptical. I think that they're going to formulate the plan there in Jackson Hole, but I don't think they're ready to announce it. I think that is still possibly a couple more months away. Could be wrong, but the messaging just isn't consistent yet amongst the voting members when it comes to tapering or announcing tapering. Either way, some steepening of the yield curve. Last week, we also talked about small caps, right? So if the banks and financials are going to start performing again, kind of get out of this malaise, the small caps should follow. And some of the small caps will also benefit from the service side of the economy, also coming back and online more and more as we progress. We do still have this Delta variant that the country, to some degree the world, is contending with, but much of the data still points to increasing vaccination rates, especially amongst the states with the highest rate of infection from the Delta variant. Those states are seeing 100 and 200 time increase in their, or 100 to 200% increase, I should say, in their vaccination rates. We now have more than 50, 60% of the population vaccinated, and that's not counting those who are just asymptomatic and won't really show any signs for which they'll get tested. So a lot of the analyst and strategist community is still pointing to a mid-late August peak in the infection rate for which it rolls over once again. If there's going to be, a bigger impact from the Delta variant on our market and ultimately our economy, I think it would have to stem from the way China deals with its COVID Delta outbreak. They've started in a small city or region lockdown measures, but that's in an effort to keep it maintained within that region. And kind of disavow the potential for a broader lockdown in China, which would, that would be something that leaps across the pond. If China locks down once again on broad scale, that's going to interrupt the supply lines to an even greater degree. And you're going to see a disruption in equity markets globally, which, you hurt the equity markets globally, you're going to hurt global economies. It's just kind of the way it goes when, much of the consumer wealth is tied up in, the wealthy, if you will. And if their assets are depreciating in value, they're going to, cut their discretionary spending. And again, that'll just impact. And I'm not saying that's going to happen. It's just something to be aware of. It's something to incorporate, or at least consider when it comes to your game plan. Look, we're already 7 months into this trading year, or we've completed 7 months. There's 5 months to go. S&P 500 is up 17%. If you're on pace with the S&P 500 or right around that, you start to think about, well, how much exposure, do I really want, given these different X factors, if you will, around Delta, around the Fed tapering, the general restriction of liquidity that may ensue going forward. You incorporate that and you make decisions on, okay, how much exposure do I want? How much risk mitigation am I going to employ here with only 5 months left in the calendar year and with still some unknowns? I'm of the opinion, as long as you have cash on the sidelines, you just continue to execute your game plan. For every hiccup or headwind that, the market has been faced with over the last, year and a half, if you will, it has overcome that, and then largely that's, predicated on the liquidity measures provided by the Fed, coupled with fiscal policy. Have been providing investors with a really nice 1-2 punch, for the economy and earnings to trend higher. So with that said, there's also that dynamic. If you're considering these 2 X factors, one doesn't work without the other. What do I mean by that? Well, what I mean by that is if Delta does, result, if the Delta variant does result in broader restrictions and lockdowns in China, that's a data point that the Fed will have to consider and possibly hold off that much longer when it comes to, any form of tapering. Forget messaging, but just any form of tapering. One doesn't work without the other. In terms of the perma-bear community, they're constantly beating this dual drum. Tapering, Delta, tapering, Delta. Like the two of them don't work together. If the Fed is going to taper, it has to be confident. It has to be confident that Delta is no longer a consequential risk to the global, let alone our domestic economy. So the two narratives that the perma-bears drumbeat constantly don't work together. That's just logic, folks. All right. So that's our one thing also, when we look at high yield credit spreads every morning here as part of our routine, part of our process, do want to keep in mind that, the S&P 500 has been moving higher with credit spreads, also widening out since this point here on July 13th. Is the credit market possibly pricing in, some type of disruption for equity markets ahead, predicated on Fed messaging around, its schedule for tapering, or its plans for tapering, I should say. So I would be keeping an eye on, credit spreads that much more intently going forward. Are credit markets starting to signal that they're pricing in some kind of equity disruption in the not too distant future, with the premise being, Fed tapering. And in real time, of course, you can look at the high HYG, the high yield corporate bond ETF. And as this moves lower, credit spreads are widening. If this is staying up here, credit spreads are tightening. So keep an eye on this. You might want to have this ticker on your watch list going forward. Every week, also another part of my process here is looking at what we have in the way of market weightings. Information technology dropped down below 28% last week, back in the 27s at 27.82. And also look at what happened. Remember, the NASDAQ was down pretty good on Friday as all the other indices traveled higher, with small caps leading the way. Small caps now, the Russell ETF or the index ETF IWM, up 3 weeks in a row. 3 weeks in a row, small caps. Financials took over fourth place once again in the S&P 500 cap weightings. These two right here, communication services and financials, have been doing this flip-flop dance for the better part of this year. And just last week, narrowly, 11.23% weighting in the spider, 11.22% weighting in the spider for communication services. Again, if small caps are going to continue on this winning streak here this week, more than likely it'll be at the expense there of communication services as banks, financials move higher, healthcare, biotech probably as well. And that's the game plan. That's, we started, I would say, maybe 2 weeks ago, our conversations around small caps, around the yield curve, around just the general trough action that we were thinking was taking place in the 10-year yield, getting as low as I think 1.11 or 1.12, and now upwards of 1.30. So as the yield curve is steepening, that's going to help the net interest rate margins for the banks, and that should also facilitate their weighting within the small cap ETF, the IWM. So on Friday, we took a my risk trade, and a lot of you joined in that trade with me via the Telegram communication. And this morning, we decided to make it an official trade alert. Opened relatively low at what has been its low point here in the pre-market. There's the IWM. We were able to take our first position there. We've got a couple points of entry. If it keeps moving lower from here, as it is still down about 80 cents, we'll call it, in the pre-market. So do check it out on the private Twitter feed and Telegram app. I do think this trade has legs, assuming the yield curve can steepen further over the next 30 and 60-day period. This is all predicated on the yield curve. That is really the only way this is going to work. It's not going to take much more than that. Several members of the Fed being hawkish, that'll help the yield curve as well, possibly. We're still in this lull, where Treasury issuance is subpar based on the demand side. And where's the biggest demand coming from? Obviously, it comes from overseas, as well as the number one buyer of Treasuries, which is the Fed. So trade on, and we'll see what other opportunities develop here this week. Again, we did not have a weekly research report. This week was our off week. So we kick things off again this coming Sunday. All right, every week checking out the weekly economic calendar here. This morning we got the JOLTS report, job opening and turnover, job openings and labor turnover. Job opening labor turnover survey. Still very, very elevated. These are record levels for the JOLTS report, right around record levels, but a really strong Non-farm payroll report released on Friday, showing that indeed more people, did go back to work than economists' estimates assumed. And there was a nice revision to the positive revision to the prior 2 months as well. Now you get, a couple months of these in a row. I would say 3 months of reports like this in a row, and that will probably pull forward the timeline for messaging around the Fed tapering. Tomorrow, nobody cares. NFIB productivity again. That's not going to be market moving. But we do have 2 inflationary data points that will be released this week, and this could affect the rate market, the bond market as well. Consumer price index on Wednesday, and the producer price index on Thursday, with, of course, jobless claims, and round things out on Friday with a couple nothing burgers as well. Consumer sentiment, yeah, it's important, but these are not going to move the market. Import price index, not going to move the market. So today, again, kicking things off with the JOLTS report, and then a couple, key measures of inflation on Wednesday and Thursday. And, did send out this report here this morning for those of you who are concerned about some of the seasonality around the NASDAQ. You can check this from Russell Rhodes here. You can check it out. There's an options trade in there if you are concerned. It only went out to our premium and mastermind members, not our contributing members. So check that out at your leisure. Of course, the latest report released over the weekend from Fundstrat, Tom Lee. Hopefully you guys had a lot to chew on over the weekend. And thinking about tapering, if we hearken back to the message, and this is a chart basically that showed, in May of 2013, when Ben Bernanke at the time, during his testimony before Congress, announced the Fed's tapering of asset purchases schedule. The S&P 500 had about a 6% correction over the course of maybe a month and a half. And before, it did nothing but travel higher into the end of the year. The S&P 500 was up 30% in 2013, folks. It was up 30%. Well, then it can't get much better than that, except for the fact that the S&P was up double digits again in 2014. Remember, it's, the financial media, they love to paint these narratives, about the withdrawal of liquidity, the withdrawal of support from monetary policy, the policies of the FOMC. In reality, the Fed has done much more than it did last time, post the great financial crisis. Secondarily, these are only minor hiccups. You could almost make the argument that the financial media paints a narrative for which the algorithms are then coded to, because they prey on that fear that is produced from these financial media narratives. The coding and the algorithm goes into the keywords, or it highlights these keywords, and when the announcement is made, the market triggers. It triggers the algorithms, and they work their magic. But that magic, I think of as an through the lens of an optimist. I think it'll be a good opportunity. As I said last week, there will be a hiccup in the market. Make no doubt about it, folks. There will be a hiccup in the market. Guarantee you. The algorithms are already, waiting to pounce. That should be part of your game plan. Have cash on the sidelines and, execute. This was a hiccup back in May 13th and nothing more than that. Remember, for the Fed to actually make such an announcement, it means that the data that they've been accruing over the last several months and to date suggests that the economy has the ability, has the strength to stand more so on its own 2 feet than Fed support. Yields will likely move higher. So the S&P 500 is this line here, so, up, down, but ultimately higher until the end of the year. The other line charted is the 10-year yield, which you can see. Here's the tapering announcement and basically doubled. The 10-year yield doubled from we'll call it 1.6% all the way to 3.10, just about doubled through the end of the year. What does that mean for tech if yields are going to rise that sharply, right? We just saw last Friday, 8 basis points higher. 8 basis points higher on the 10-year yield. And what lagged? What was under pressure? NASDAQ was down 0.4%. And many people will tell you, well, what happened during the earlier portion of the year where the NASDAQ, tech, and growth underperformed while yields kept rising should happen again. To me, that seems unlikely. The market has a playbook. Investors saw what opportunities developed back then with tech, with growth, with NASDAQ, with FanMag. A lot of them missed out on it. So their impulse to buy the dips in those areas of the market where the earnings were just released and still very strong. But there's not much that investors could do at this time because the prices had already run up into earnings for tech, for semiconductors, for Facebook, Amazon, Apple, Google, all of these names, NVIDIA. There wasn't much that they could do about it. People don't like to buy at or near tops. They want the opportunity to buy at cheaper prices. In my opinion, if yields continue to rise from here, and I do believe that there's strong potential to get back to at least 1.5% by the end of the year, but I don't think we see the same one-to-one correlation with NASDAQ, growth, tech, FanMag as yields rise. And everybody as we talked about here just a minute ago, we are expecting, if the yield curve steepens, for financials, small caps, banks, to reappreciate as they were earlier in the year, but not to the same degree either. Rarely does the market give you a second chance. It's not what the market is about. The market is generally looking to make as many investors look foolish as possible. If everybody is thinking, well, the reflation trade's on again, that must mean tech, NASDAQ, and growth are off again. If that's where the most concentrated, analysis is and participation is going to be, why should we think that's what the market is going to reward? Usually the market doesn't reward where the boat is most heavily loaded. That's where it wants to make the greatest amount of fools. And to my point about buying the dip, we talked about this a couple weeks ago as well. Are investors really going to let the NASDAQ fall 8 to 10% like it did on 2 separate occasions from February through May? And this chart right here shows you we've had a lot of, 2 to 3 sigma events in the market here this year, 10 to be exact, the same amount that we had in 2014. But the days to recover are only 2.6 versus 7.5 just about here in 2014. Investors are buying the dip that much more quickly. And you put this together with just, the psychology of what happened here and how so many missed out. Remember, Apple in the 1 teens up to a new all-time high of $150 a share in about a month. In a month. How hard was it for most to buy Apple when it went from 117, 118 to 135? Right? Most people, it'll dip back down again. Well, it didn't. Who do you think is buying up here other than long-term institutions? So you give them that opportunity. Again, I think the dips are going to be shallower. Bigger dips will need a catalyst. The reflation trade is not, in my opinion, going to deter growth, NASDAQ, tech, FanMag to the same degree it did earlier in this year. Again, in my opinion. Small caps, looking underneath the hood of the Russell or small cap S&P 500 portion of the market, and we can see the advanced decline line. Again, small caps rallying 3 weeks in a row. We can see the advanced decline line has trended up nicely and just broke above the 50-day moving average there. In my opinion, it has room to run, and as long as the yield curve, shows some steady progress, small caps should continue to run. May not be in a straight line, don't get me wrong. Earnings. We've revised our earnings estimates for the year. We're up to, 208 or 209 for full year 2021 earnings. When we look at this chart here, however, this is the quarterly bottom-up EPS actuals versus the estimates. So we've got data going all the way back to Q4 2019. Here we are this year. Q1 is complete, $49 a share in earnings. So far in Q2, earnings are upwards of $52 a share. We still have 2 weeks to go. Next week, we'll have the retailers reporting, by and large. We're going to get Walmart, we're going to get Target, we're going to get Macy's, Dillard's, all those types of Kohl's, so on and so forth. This is not finished. This is Q2 2021. Look at Q2 2022. It's only 53.88. This may be where we end this year in the Q2 period. But what does this tell us? And look at Q3 of 2022. It's only 55. Q1 of 2022 is only $2 higher than Q1. That's it. I mean, the earnings estimates for next year just aren't going up fast enough. The message from the market, which just cannot find a closing basis 5% decline, the message from the market is, we know these these quarters out there in 2022, as well as Q3 2021 and 2024, Q4 2021, these are going to be higher. These are not realistic. Again, we're probably going to be here at 53.88 for the Q2 2022 period in Q2 2021. By the way, the S&P 500 multiple coming into this week, 21.1, the lowest it's been in about 45 days now. It briefly got to 20.8, maybe almost a couple months ago. In the last 3 weeks, the S&P 500 forward-looking PE multiple has dropped from 21.8 to 21.5, now 21.1. The market is cheaper today than where it was 3 weeks ago, even with the S&P 500 moving to all-time highs and closing a new closing high as of last week. How does that happen? Again, the earnings estimates, the realized earnings are moving up faster than the S&P 500. The S&P 500, is only making these very modest, churning new all-time highs. The new all-time high on the S&P 500, 4440. How do you like your fours? 4440. The previous all-time high, 4429. It's an 11-point new all-time high. That's it. When you've got earnings per share moving up by dollars every week, with still, as I said, Walmart and Target are going to be reporting next week. Let's see what those dates actually are, just to be sure here. 8:18 before the market opens, and 8:17, I believe, on Walmart. Yep, 8:17. And heads up this week on Walmart, dividend, qualify for the dividend of 55 cents a share. If you hold shares through 8/11's close, through the day before the ex-dividend date, 55 cents a share. Walmart bid up here, got into the 146s last week with, I think it was an upgrade and positive commentary from Jim Cramer on his Mad Money show, where it actually fell on Friday. It did get up to the 146s in the early morning, gave everything up, and was actually down by about a quarter on Friday. People using Jim Cramer's Mad Money sentiment to, sell into, maybe lighten up a bit, in my opinion. The problem here when it comes to, not the problem, but investors need to be smart right now. They need to be smart. They need to understand what has happened. I see a lot of comparison. You got John Najarian or Pete Najarian on CNBC. You got Guy Adami, even Jim Cramer. Target is still cheap compared to Walmart. And what have we identified in the past? Nothing is cheap forever, because that's been the relationship forever. Target is always cheaper on a forward PE multiple than Walmart. Why? It's the contribution of revenues. Where do they come from? The greatest contribution of revenues for Walmart comes from grocery. Some 56% of Walmart's revenues are grocery. So it's a consumer staple stock. It's in the consumer staples ETF. It's not in the consumer discretionary ETF. Target only has about 25% of its total revenues coming for grocery. So it's in consumer discretionary. It's not in the consumer staples. Consumer staple stocks carry a higher multiple than consumer discretionary stocks. Absent the of course, Amazon. That's in its own world, even though it's in the consumer discretionary ETF. So my point is, these folks on CNBC, no, you have to know why. Nothing is cheaper just because, and nothing is cheaper. If it's cheaper forever, then it's not cheap. That's the way it is. It's fair value. Target is trading at fair value, which means it should always be cheaper on a forward PE basis than Walmart. But the two are close right now. Therein lay what investors need to be considering. How much of the good news is already priced into Target stock? When you look at that thing on a chart, it's a beautiful thing, don't get me wrong, but it does reek of be careful. This company is likely priced to perfection. Look at this. You barely had a hiccup here. It's just off to the races. Look at the 2-year. This begs of the good news being priced in. I still think the company's going to have a great quarterly report, But like many other companies that have issued great quarterly reports, even strong guidance, they've been sold off. It wouldn't surprise me if Target came under pressure, post its results. Maybe not that day, but over the next 30, 60, 90-day period until its next earnings season. It would not surprise me. It also wouldn't surprise me if we pulled up the Walmart chart. This one has been under consolidation for a good period of the year, if not the whole of the year. Look at this. It's just a lot of sideways, choppy action, big dips and big rips, which is what consumer staple stocks do. They tend to underperform for a long period of time, and then they tend to market perform. But within that whole paradigm, there's usually a big dip and a big rip so that it can get back on to a more market perform, even keel, if you will. But Walmart still underperforming on the whole of this year. Look at the return. It's up about 12% here. S&P 500 is up 17%. Consumer staples underperforming. Well, where's the opportunity for investors? That's also another, key input here. Is the opportunity in the chart that I just showed you from Target, is that where the best risk reward is going to be found? In a stock that has basically gone parabolic through the course of 2021. Is that where the best risk reward is? Or is it in a stock that is, underperformed, but still has very strong fundamentals and may play a little catch up? Are we really of the opinion that more investors are going to pile into Target? It's possible. I'm not saying it's not possible. But as investors, we deal with probabilities. What's the greatest probability? Is it that there will be more investors piling into Target? Or will some of those strong fundamentals that Walmart has already delivered in its first quarter? I think one of the reasons why Walmart has also underperformed is simply just because of the nonchalant, rather underwhelming guidance that the CEO offered, during that first quarter release and conference call. What better way to drive investor enthusiasm than to deliver an underwhelming guidance, make that bar easier to jump over in this upcoming release? Again, analysts out starting to upgrade Walmart. I think we had Oppenheimer and Wells Fargo last week. One more week to go here before earnings and the big two, if you will, Walmart and Target. We'll see what happens. All right, moving on. So again, earnings, there's a lot of room for these to get revised higher, folks. And I think one of the only reasons why we haven't seen greater revisions, to 2022 estimates is simply because we do have a tapering variable and we do have a delta variable out there. So the analysts are, hesitant at this point. Market, not so much. Again, here's Tom Lee, moving to a full risk on into the month end of August. There are multiple positive catalysts driving a full-on risky rally into month end, possibly into the end of September, 4,500 price target. And he's into the reflation trade, energy, the jets, the airlines, and the casinos. Oil field services via OIH ETF. So again, if you haven't read that report, go check it out at finomgroup.com. Here's some of the statistics on the NASDAQ. We talked about that. These are the best months performances since 1990. Looks like, here, it had 1 month since 1990 where it was up 25%. I am going to venture to guess that was during the dot-com period. The worst months, there's August, 17%. Here's the average return for the NASDAQ by month going back to 1990. Going back to 1990, the average by month. And the worst is September. It actually has delivered a negative return for the NASDAQ. Not a big down month, but still on average down. February is actually worse than August. My apologies. February is actually worse than August. The percent positive by month going all the way back to 1990, February, it's only a 50-50. So is June, 50-50. August, 58%. So is September, 58%. Only 51% in December, going back to 1990. So this is the NASDAQ, not the NASDAQ 100, folks. And what we know about the NASDAQ, because I've been seeing a lot of these, the NASDAQ breath is so weak charts out there. In fact, and this is one of those parrot type Twitter accounts where they just basically parrot out or retweet statistics from noted banking institutions, Morgan Stanley, JP Morgan, all of Wells Fargo, all the different banks. But this was a chart by Isabel Net this morning, which speaks to, is it time to reduce exposure to tech stocks as the NASDAQ breadth has not matched the rise in the index? And this is from Morgan Stanley. And indeed, you can see the strongest equity index, which has been the NASDAQ, has some of the weakest breadth on record. Percent of stocks in the NASDAQ greater than the 50-day moving average. And coming into today, if we look at, NASDAQ 100, so let's go to the NASDAQ. And this is a perfect point that I'm making here, that I want to make here. Like, this is the NASDAQ percent of stocks above the 50-day moving average. It's only at 37%, basically, roughly 37%. How can the NASDAQ, have achieved these record highs and outperformed for the last 3 months, and breadth, the percent of stocks above the 50-day moving average has not been at 50% since basically the first week of July. And it's been downtrending since then. And yet the NASDAQ itself has been uptrending. Now with, 16, 17 new all-time highs this year for the NASDAQ. How does that happen? Right. Well, again, keep in mind what the NASDAQ is. It's a cap-weighted index. And when you look at the cap-weighted NASDAQ, 51% of the index is the top 10 stocks. 51% of the NASDAQ is tied up in 10 names. And they make up the top 10 names in the NASDAQ 100 as well. Apple, Microsoft, Amazon, Alphabet, Facebook, Tesla, Alphabet, NVIDIA, PayPal, and Adobe. These are the top 10 in the NASDAQ 100 and the top 10 in the NASDAQ as well. It's a cap-weighted index. 51% of the index right there. And what have these stocks been doing? They've been trending higher by and large. Tesla recently closing above 700. Upgraded this morning, I think, also Tesla, or at least positive notes. The S&P 500, not so much. While it's still a cap-weighted index, the top 10 stocks in the S&P 500 make up only 25% of the index. It's less concentrated. Here's the top 10 stocks. Do they look familiar? Of course they do. But it's only 25% tied up in the top 10 stocks. Whereas the NASDAQ, it makes, the top 10 stocks make 51%. So when you're defining NASDAQ breadth, you must rationalize for the NASDAQ 100. If you don't, the weakness in the NASDAQ breadth may prove of little consequence. And so again, you look at the NASDAQ percent above the 50-day moving average. Indeed, it looks like a crap show. When you look at the NASDAQ 100 above the 50-day moving average, it's at 73%. And, it's been above 50% here going all the way back to late May. Dropped briefly below 48. Well, yeah, I guess, yeah. This was, period of steep decline there. I think the NASDAQ corrected 8%, but that's what has to happen. You've got to get those top 10 stocks. You've got to get them to correct. If they don't, the NASDAQ can still carry higher with very weak superficial breadth. Can that happen? Of course it can happen. But again, look at the results that were just delivered, from these names. They all beat. And the only one with any real flies on it was Amazon, based on consensus estimates, missed revenues. That was pretty much it. All right, we just tipped over the top of the hour here. Futures got worse, at least for the NASDAQ. They got better on the S&P 500, and the VIX has come in just a little bit there. Apple here this morning, basically flat. Microsoft this morning, speaking of NASDAQ and tech, it's actually bid slightly higher. Let's get back to and look at that. Look what happened to the small cap ETF. We were looking at 222.50s, now 223.20s. What does this tell us? It tells us to go look at what the 10-year yield is doing. And the 10-year yield is almost back to unchanged. Remember, it was down 1 basis point. Now it's only down 0.003. The dollar here in the pre-market, only down a penny, not doing much. Oil has been under some pretty good pressure here all morning long. This might, be speaking to the demand from China, some worries about COVID over there, the Delta variant over there, and how they're, taking action. Gold. It was all the way down to $1,700 a troy ounce. I want to say 6:00 p.m. Sunday evening, when equity futures open, dropped all the way down to $1,700 a troy ounce. Still under pressure. One of the worst performing assets of 2021. Crypto this morning has a really strong bid. Got above that 42,000, I think, resistance level on Bitcoin. Now 45 and change. I think we're going to hear a lot about, the upside potential here for Bitcoin in the crypto complex now that we've gotten above these key resistance levels. European markets here this morning coming back as well. The DAX had been down about 0.2% or 0.25%. Now almost back to unchanged. Stock 600 up a little more than 0.1% there now. So everybody have a great trading day. This is what we're looking at here in the trading room this week. And if you'd like to join us in the trading room, subscribe at finomgroup.com.